Honey, good morning to Wall Street. Janet Yellen has a message for you. She doesn't put a timetable on it, but she says the economic data have improved and, quote, the case for an increase in the federal funds rate has strengthened in recent months. Parse that how you will on Trading Desk, but it is the most optimistic and direct Janet Yellen has been about interest rates in quite some time. The labor market has improved, she says, and inflation, while still low, is still subject to the transitory effects of energy. Yellen goes on to caution the outlook is uncertain and that policy is not on a preset course. The Fed's ability to predict where rates will go is, quote, quite limited, she says, because what she calls disturbances and headwinds continue to buffet the economy. Still, over the longer run, Yellen adds that forecasts show the federal funds rate settling at about 3% in the longer run. That is higher than most people on Wall Street would put it. Much of the rest of the speech is a defense of the Fed's policy actions during the recession and recovery, how they have worked and contributed to the economy, including zero rates, a big balance sheet, interest on excess reserves, and forward guidance. Yellen goes on to say that we, at this point, need those tools going forward, although she says the Fed is not at this moment studying the idea of targeting higher inflation or nominal GDP. She goes on to talk about the need for some fiscal policy going forward, but doesn't make a big deal of it. And Yellen says that in the future, the economy should grow. Now, interestingly, the Fed chair also makes a defense of the Fed's ability to respond to the next recession, even with low interest rates, because she says in the past, recessions have started with the Fed funds rate higher than it should be. So much of what the Fed did was remove excess accommodation. With interest rates so low right now, that's not going to be a problem.